Good deal. All right, awesome. So again, welcome. Oh, your application. Still learning the tech in here. So let's see. Click OK. Oh, I see. I can actually click it from here. All right, I didn't realize. When there's two monitors, I have to figure out which is which. So again, welcome to Moneymakers Club meeting. Again, attendance kind of varies. We normally have a daytime meeting here at Kent in the Fintech room, which is a smart classroom. So these white blocks here are actually smart mics, and they'll actually follow me around the room. We actually have a smart camera over there, which will also follow me around the room, which is pretty cool tech. And I'm recording this, so that way I'll email a link if you have your email in my emailing list for the club, then you can get a link and you can watch the video later. So we'll introduce ourselves. Professor Velasco, I'm the club sponsor, and we actually have had all of our officers graduate this past fall. So our officers are now open for vacancies. Basically, it's there's no elections. So if any member here listening or here wants to become an officer, we only have 4 positions: president, vice president, secretary, and treasurer, all the functional positions. Then I welcome anyone to volunteer for this upcoming fiscal year. I just went through the budget hearings this month for our club budget. So I'm just waiting to see if we got approved for budget money. And really our budget's really for food for meetings. So we have a nice, manageable, easy to understand budget. So treasurer is not too bad of a job, because we have banners and other things for the club that we've spent, which were one-time expenditures last year. So our budget's a little simpler. We are a club where we share information. Most of our members are beginners, so we have some more experienced investors, but it's really just sharing information to grow wealth on your own without having to pay someone else, which is basically one of the tenets of our club. We always want to educate ourselves to make sure that we are making the right decisions, growing our wealth. And we talk about any type of asset, whether it's stocks, bonds, futures, crypto, options, gold, silver, even art, as one of our students suggested. So anything you want to talk about, we are always open. And most of the topics that we talk about every month are always member driven. So whatever members want to talk about, I take suggestions and I try to create a handout for what we talk about in the following meetings. Now, that being said, my class schedule is a little more full this semester. I'm teaching about 9 classes, so all of my evenings are booked through the end of April. So unfortunately, we aren't able to have an evening meeting, but we try to accommodate different schedules. We also try to accommodate different parts of town because Jacksonville is so big. So on this side of the river, for our downtown and Kent students, we have our Kent meetings here during the day to accommodate the nighttime folks. And then we have meetings in the evening at either Deerwood or South to accommodate our South Side and daytime workers. So we unfortunately had to cut out that because I teach, but I'll be able to open up the evening meetings starting next month, now that my full spring schedule will calm down a little bit once I get on the summer schedule. So that's me. I teach 4 different types of finance classes. I have a background in both accounting and finance. I work for the private and public sector. And I'm also a practicing options trader. So I trade options every week. Matter of fact, I put on some trades the last 3 days, Thursday, Friday, and yesterday, trying a brand new strategy that seems to work, where I placed a trade right before the market closes, like about 3:15, and then just babysit it until the market closes at 4 to see if the trade works, and it's worked pretty well. So I'll have to talk about that in the future, because I'm doing some more trials to see, one, its success rate. I know it's batting 90-some percent. Because I did a little more risky move yesterday just to see how much I could take it with as much risk as I can take. That one lost, but then all the winners kind of offset that, so I was ahead for yesterday, and numbers were pretty impressive. Like Thursday, I think in 45 minutes, with options trade on the market, using just the S&P 500, I think it's about $500. And then Friday, I put on, I scaled up the trade, and I think it was a 13.50. Pretty good for 45 minutes.
Yeah.
And then yesterday, I tried for 700, but then ended up with about 500. Still, a really good hour.
Yeah.
A good way to spend an hour, which should pretty much take care of a rent or a mortgage and stuff like that. So that's actually one of the topics that was suggested, but I want to save that for like a bigger topic for next month. Because we've done options as a topic before, but I'll since it's so big, I might want to devote a whole session just to options. So are there, let's continue with introductions. Feel free to introduce yourself to our little group and to our recorded viewers. Yes.
And I'm a beginner. I don't know much about any of this stuff.
That's okay.
But
That's most of our members.
Like most during COVID, I guess, I got on Robinhood and I played around.
Like millions of people
Right,
did.
like millions of people. I haven't gotten rich yet.
The key is to start.
Yeah, so
I mean, I have a Robinhood account myself.
I'm trying to learn. I mean,
Good.
I don't know much. I haven't made anything, but I'm also not like where I have a whole lot out there because I'm trying to figure it out.
I'm going to make sure that you get, we have an educational packet in Word, which has books to read, websites to go to, and also some documents that you could, other types of resources to teach yourself all about investing and trading. So we give that to all our members, since you're on the email list, I'm going to send that out within the day. So that'll give you a great start. Yeah, yeah. So so that'll give you a start. One of the topics for today are actually new ETFs that have come out that I've been investing in, not trading, but actually just outright buying, that provides a really great passive income. So thanks for coming. Hopefully we'll see you in the future meetings.
I hope so.
Again, no dues, it's totally free.
Yeah.
Right.
Yeah, my name is Braden. Nice to meet you. I've been coming, say about a year now.
Yeah.
3 years, something like that. I'm actually graduating, I guess this spring. So I'm a realtor here in Jacksonville. So I've learned a lot about real estate investing just from self-study over the last probably or so. And obviously more about real estate in general, just working there. But yeah, I love coming. I come pretty much every time he has a meeting, and I always take something from it. So it's like he said, it's free. It's free knowledge. You come in, and I can ask him questions or ask other people
You
questions.
can always pick my brain.
Or yeah, and so it's really interesting. I enjoy coming because I always take something from it. So
Great. Thanks again. And those of you that are watching online, feel free to come for a meeting as well. So what the market's been doing lately, we always spend just a couple of minutes because it's always good to be market aware of what's going on, because I, like very few people, look at the news differently than others. Sure, I watch Fluff too. I enjoy my Fluff. Like, I watch Famous Rules on Bravo. But other Fluff, it's like things happen on the news, whether it's social, economic, political, and if it has nothing to do with giving me ideas of how to make money, I can easily ignore it. I don't let it affect me at all. Like, for example, I bowl in a league, so one of the bowlers was asking me, hey, what do you think about this Trump indictment? I go, I haven't really thought about it because it's no catalyst to make me wealthy, so I don't even pay attention to it. So what's the market been doing lately? There's been a lot of activity on the markets, primarily when it comes to inflation interest rates and the recession. So we all know, just from seeing prices go up everything we buy, we're in a recession. We have been for months. So I know there's a textbook economic answer is if there's 2 consecutive quarters of lowered productivity, that's a recession. But we all know we're in a recession. And the reason why I say that is because measuring a recession is a lagging indicator. By the time you realize you're in a recession, it's already happened. So the beginning of the recession has been going on. We see it in gas prices. We see it in eggs. We see it in food and services and clothing or anything we need to buy. All those prices have gone up. And even though recession has dropped from a peak of about 9% last summer to, they just measured it last week, the consumer price index is down to 5%. That's still double what price growth should be. And so in order to combat that, the Federal Reserve has been raising interest rates for about a year and a half. And interest rates are about close to 5% right now. And that's not a great thing because, again, it can slow the economy. It makes businesses more expensive to operate because when they need financing, they have to pay a higher interest rate. When you need to take a loan out to buy something, whether it's a home or a car or even credit cards, the interest rates you pay, that's also more costly. So those rates to combat inflation are also affecting everything else that we spend money on, even especially big ticket items. So we're kind of having to endure or suffer the cost of everything being high just to hopefully get inflation back down. And I don't envy the Federal Reserve of having a tough time deciding between making sure employment is stable, because there's still a lot of unemployment out there, as you've probably heard from other friends or in the news. Inflation is still high, so that's another reason why they need to raise interest rates. But we're also in a recession. And normally, in a normal environment, when an economy is in a recession, one of the best ways to combat a recession, like the COVID recession from 3 years ago, is for the Federal Reserve to lower interest rates. Well, right now, their hands are tied. They can't. So their main tool to combat inflation, the lower interest rates, they can't use because at the very same time, we have inflation. So they're forced to raise interest rates to combat inflation first. So that's the priority. Get inflation down, maybe have to suffer through more recession, but if inflation comes down, then maybe, not this year, but maybe next year, they could start bringing interest rates gradually down on that recession and get the economy back to somewhat normal. So in normal meaning stable employment, meaning that usually unemployment rates like 5% or less. And that's around where employment is right now, even though there's still a lot of job openings. I can't go to any service industry business, mainly restaurants. And it never fails that I will always see a now hiring sign on the door, or I'll hear from staff or management saying that I could barely keep people here. I could barely attract people to come work as a server or a cashier or someone. And we see that all the time. A lot of people that left during COVID didn't come back to work.
Yeah, what's I mean, mine's obviously the expensive everything. Obviously, service industry doesn't pay the greatest. So
Right.
do you think this people just are seeking better pay or?
Yeah, people are, I think in America, at least, people are just seeking better pay. They figure, well, it wasn't my favorite job to begin with, working as a server, so I'm going to try to find another type of job that maybe can give me a better working environment, better benefits, better pay, and they're just not coming back. And because people feel that, or American workers feel that the level of rigor that is required for a service job, the physical demands deserve higher pay. And so, and there's arguments on both sides about that. Say, well, these are low skilled jobs. We need to only pay them so much because then they'll approach like people who went to college and got their degrees and majored in something and they get paid for that. But then people work so hard physically, warehouse jobs, service jobs.
Yeah.
So they work hard too. And there's argument to me that, those people that work hard in service deserve a higher level of pay. So there's a push and pull between business owners and servers, and then the business owners that decide to pay a higher wage to attract people to work for them, they have to compensate by charging higher prices for the menu items. And then ultimately that can hurt people who make regular wages, because the people who are making average wages see the prices of all the businesses that they buy from go up because they're paying wages. So it's kind of cyclical. So it's a tough decision, and I don't envy the business owners having to choose between that. So that's basically what the market's been doing. And because interest rates have gone up, the market has been in a bear market. Stock markets don't like high interest rates. And basically, to put it simply, when interest rates are high, businesses to finance their operations, it costs them more money in interest costs. And when it costs them more money, it is a bigger expense. And when there's a bigger expense, they make less profits. When they make less profits, then buyers of the stock bid the price down. So stocks have been dropping since interest rates have been going up. They generally move in the opposite direction. If interest rates go down, stock prices generally move up. So there's an inverse relationship between that. So that's basically what I pay attention to in the market a lot, because that can affect how I'm going to trade. And you should never fall in love with a particular trading strategy. You always take what the market gives you. Like last summer, we were in a bear market. I was choosing to trade ETFs that move in the opposite direction of the market. So if the market was going down, I was trading ETFs that go up in the opposite direction. And if you're not sure what an ETF is, it stands for Exchange Traded Fund. And it's like a mutual fund where it has a whole bunch of different stocks in it, but you can trade a share of an ETF just like you would a stock. You can buy and sell them. So instead of picking individual stocks to trade, you can just buy one ETF that represents a whole class of stocks or a whole bunch of stocks. And we'll actually have those as part of our agenda item too. So that's certain ones that I'm going to talk about. This one's just kind of fun. Only takes a minute, but I wanted to share why it's important to start early and be diligent in investing. And this one's the story of Grace Groner, which I learned about last month. So again, she didn't work a fancy job. She was a secretary for Abbott Labs. And she worked for Abbott Labs for 43 years. I can't even imagine working at one employer for 3 years. The most I've ever worked for any one single employer is actually here. Because prior to that, my previous job, I worked there for like couple years, 7 years, 8 years, 7 years. But here, actually, I'm reaching my 10th anniversary, which is the longest I've ever worked at one place. And I don't expect to come even close to 43 years like this young lady did. She lived pretty frugally, tiny 1-bedroom cottage, didn't own a car. Ultimately, I don't want to own a car. She bought her clothes at rummage sales. Nothing wrong with that. I mean, I bought work clothes from like Goodwill and Salvation Army because they actually have some good stuff at low prices. So when she passed away in 2010, she lived to be 100 years old. So long life. Although again, she almost worked half her life. I mean, I don't want to work half my life. That's why I'm trading. But at the age of 100, she left her estate to her alma mater, Lake Forest College in Illinois. And the reason why this particular story became nationally renowned is because the school's president said, "Oh my God," when they learned of how much she left to her alma mater. So, well, how did she do it? She built her wealth very simply, and you can actually do this too. When she was working at Abbott in 1935, she bought 3 shares of the company. At the time, they were about $60 each. She spent $180, which wasn't that much back then. And she just held on. And I have a similar story myself with my Microsoft stock, but she held on to the shares. The stock continued to split over the 40 years. And by the time she was 100, it grew to a hefty $7 million, which is pretty darn amazing. So again, $180 to $7 million just from buying quality and not selling as the stock split over time. It must have definitely enough, but
Yeah.
nice part is I believe Abbott Labs also pays a dividend. Do you know what a dividend is? Okay, yeah, I think we learned that in class. So basically you get a piece of the profits in cash. And what she probably did was reinvest that dividend to buy more shares. And that's what I've done. So if you want to basically earn money in your sleep, passively is definitely the way to go. But it's very powerful because of what we learned in chapter 3, 4, and 5 about compound interest, how interest builds interest on itself. So companies that pay strong dividends, let them sit, reinvest the dividends instead of accepting the cash. A couple of things we talked about in Investment Club before was two things you can Google. You can Google a term called dividend kings, and you'll come up with a small list of stocks. And what makes dividend kings so special is if you're not sure about a stock to buy, these are ones that are a good place to start, because these are stocks that not only have paid a dividend every single year, but have also raised the amount of dividend every year for 50 years straight. So basically, these stocks have a track record of giving you a raise every single year and how much they pay you. The other term to probably look up on Google is called dividend aristocrats. And like the dividend kings, they also not only pay dividend, but have paid the dividend every year for at least 25 years straight and have given you a raise for 25 years straight. And on both lists, you'll find very common names like Home Depot, Lowe's, Pepsi, Coke, Kellogg's, Johnson & Johnson. So not unfamiliar names. Basically, all these businesses that are on both these lists are businesses that probably are not going to go out of business anytime soon. They always make products and services that people are going to buy regardless of what the economy is doing. So even in a recession, what are some things that people are still going to need? Toilet paper, toothpaste, soap, deodorant, spices. I mean, spices and toilet paper. When we had the COVID recession in 2020, you can imagine people were just clamoring since they were stuck at home buying truckloads of cooking spices and toilet paper. I mean, there's viral videos out there of people trying to snag toilet paper off the shelves, stick them on a truck. It was crazy. But the companies that made those just continue to make money, even today. So again, it doesn't have to be complicated when you're investing in stocks. Again, my own story, I always share all my classmates or all my students. First stock I ever bought, I was still in school studying. I was working at night part-time, using part-time job money. Bought 10 shares of Microsoft because that's what I could afford with my part-time job money. At the time, Microsoft was $150 a share. So it's also a lesson to where it doesn't matter how expensive the stock is. If you're buying quality, I'd rather buy one stock of a good company that has an expensive stock price than 1,000 shares of a real small, cheap company that you might lose all your money with because it's not that great of a company. And that's where people get a lot of trouble with penny stocks. And I consider penny stock anything less than like $8 or $5. So to make long story short, over time, those 10 shares, and I haven't bought a single share of Microsoft since I was a young person in school. And I thank my mom for getting me interested in stock investing. But those 10 shares, they split 10 shares into 20, 20 into 40, 40 into 80, 80 into 160. Now I've got 200 and something shares of Microsoft stock, and they didn't start paying dividends until the 2000s, mid 2000s. But I checked off the box and had all those shares reinvested, except the first dividend. The first dividend was a special dividend where they paid just a one-time around Christmas time, right in December, $3 a share. And so I had $480 in cash sent to me in a check, and I was tempted to buy an Xbox with it. But I decided to reinvest it and buy a stock of another company, which split a few times. So again, you just give it time, buy quality, never worry about the price. And the nice part about apps like Robinhood is if a stock really is expensive to buy one share of, you can buy fractional shares these days. That's modern technology allows you something that you couldn't do 10 years ago, or had to find a place or a way to do that through a special bank. So every month, even today, at first week of the month when I get paid, then I put $100 into buying a share of Amazon. I put $100 into buying a share of Alphabet. At least those are the two I'm picking right now. And so the nice part about buying shares around the same time and for the same dollar amount each month is that you never have to worry about luck, and you never have to worry about the timing of when you buy the stocks. Because if the stock price is high that particular day that you buy it, then you buy less shares when they're too expensive. And that's okay, because you're still spending the same dollar. If the stocks are down that day, that's great, because as long as nothing has fundamentally changed why you still like the company, you get to buy more shares when they're less expensive. So over time, as the stock price rises, the average cost that you pay is still going to be low, and you should still be ahead. So right now, Alphabet and Amazon stock hit above $100 for the first time in a few months. So I bought less pieces of them, like a fraction of one share this month, and that's totally okay, because I bought more than a share, or at least a share, all those months previously, so like last fall. So definitely something to keep in mind. Grace Groner is an inspirational story about that it's not hard if you pick quality. So the next item I want to talk about today are these, and to put my money where my mouth is, I actually have shares in almost all of these, but I wanted to add a couple that are on my watch list, and I'll tell you why I haven't bought those yet. So this topic here are new monthly high dividend ETFs. So ETF again stands for Exchange Traded Fund, and these represent or track either an index, or these ETFs are actually invested in dozens of shares of various companies depending on the particular strategy that they are going for. So I put like just a one sentence phrase, just a general description of what these ETFs do. So the first one is called DIVO, or DIVO, which is a very appropriate name. DIV, of course, stands for dividend. So what this manager does, and these are all actively managed, real humans are actually managing these. So these are large cap companies, meaning companies with at least a net worth of 10 billion or more. So you're talking about most of the companies that we've probably heard of, especially the big ones: Microsoft, Apple, Amazon, Alphabet, NVIDIA, so Pepsi, Coke. So large cap companies, they buy shares of companies that have dividend growth, so ones that not only have paid dividends, but have increased their dividends every year. So they'll buy up those shares. And to increase the amount of income that they pay you each month, they do what's called a covered call strategy. So what they're doing is they're selling option contracts on the shares that they already own. So as a result, you get an average annual yield of about 5%. And that's pretty decent. So for a lot of people, that's actually pretty good. And if you compare that to the rate of interest that you're getting on your checking account in your bank or credit union, is maybe 1%. 5% is 5 times that. It's a little more attractive. The catch is, whatever you earn, whether it's stocks, bonds, savings accounts, whatever, you always want to beat inflation. Inflation right now has made it very difficult to try to get ahead, or to try to earn a rate of return to at least cover inflation and then some. So that's why it's so high. But hopefully inflation keeps on going down, and the rate of return of these will start beating it for all of them. So with this, you'll based on last week's inflation rate, we're breaking about even. So the value of our dollars invested in that at least have retained its value. We aren't losing our purchasing power, and that's pretty attractive. What's a nice part about DIVO is, because of all the growth stocks or the well-known names they've invested in, the value of the ETF shares have been pretty stable. So not only are you getting the 5% income each year, and on a monthly basis, the value of the shares that you bought is also stable, so you aren't losing that value. SCHD, I'm not in this one either, but it's a little more conservative. It tracks what is the Dow Jones 100. So the Dow Jones, again, it's a publication. They have a list of the 100 biggest stocks in terms of value. So all the big names, again, similar to this. The difference between this one and this one is the companies that are big that they buy all pay dividends. The Dow Jones 100, some of them pay dividends, maybe some of them don't. So what they'll do is they'll buy the 100 biggest companies in the Dow Jones and then let those grow. And that's about 3.5% with the dividends. The rest of the ETFs that I have listed here, these 7, I actually own all of these. My biggest positions are this one here, XYLD. My newest big position is an SVOL, JEPI, and JEPQ. So XYLD, this one, they track the S&P 500. So what they do is they will basically invest in the index of the 500 biggest stocks. But to generate a much higher income for you each month is they sell covered call options on the stocks that they own of the S&P 500. What attracted me to XYLD is that they invest in the big companies, but the yield is 12% due to that options income. So I've got a big position in this where I bought a lot of shares in XYLD, and they pay me monthly income. And so I'm actually taking that monthly income and I'm using it to actually buy more shares in those four. QYLD, I have shares, but I'm not adding any more to this one. I'm just staying pat. This one tracks the NASDAQ 100. So basically the 100 biggest tech stocks or high growth stocks. So a little more risky types of stocks is tech stocks, growth stocks, they are a little more volatile. They move up and down in price a little bit more. But they also sell covered call options to generate income. And so the monthly yield or rate of return is about 12.75%. And this is the actual cash that you get. This is the rate of return you get on just the cash, not on the ETF value moving up and down. So again, very attractive, but the reason why I don't buy any more shares of this one is because since they're buying a lot of high growth stocks, if the stocks grow up pretty high in value, they miss out on the gains of those growth stocks due to the options. The options basically cut off the level of, or cap the level of profitability you can get by owning those stocks. So that's the shortcoming of this, although the yield is still very attractive. SVOL is my newest position, but I am buying more of these every month. So this one is basically just tracking one type of index, and it's called the VIX, and it's called the volatility index. The nickname for the volatility index is called the fear index, because when the stock market goes down, the fear index always goes up. It moves in the opposite direction. If the stock markets are going up, then the fear index goes down. And what this manager does is he sells call options depending on the movement of that volatility index, but they only do it based on a fraction of the movements, like about 1/3 to 2/3 the whole movement of the VIX. So it's a little less risky. So because most of the strategy is not based on the growth of VIX, it's based on solely on the options, the income you get is much higher. So it's a 17% just on the cash that they pay you by itself. And that was really attractive to me. And that's done pretty well. Not only are the price of the ETFs that I bought are higher than what I paid for, but I'm also getting 17% a year in income on that. So again, compare that to what you're getting on your savings account. If you divide 17 into 72, which was the rule of 72 that we learned in class, I'm kind of curious. How fast can we double our money if we earn 17% a year? Well, let's take a calculator and find out. Again, this is ballpark. This rule of 72 is the next ballpark, but it works pretty well though. So let's take 72 and divide it by 17. Yeah, 4 years. You can double your money every 4 years if you're earning a 17% return.
Is that return primarily based on the dividends you're getting from it?
Primarily based on the dividends. That doesn't include, yeah. So even if I don't include the share price appreciation, that's just on the cash alone. Now, if SVOL also goes up in price, that'll add to your return. Although the yield's going to drop though, because if they pay the same amount of cash and the stock price goes up, the yield goes down. But that's all right because it'll even itself out.
Similar to the QYLD in that instance, to where the value isn't necessarily increasing as much, but you're getting good dividend.
Yeah. So this is the thing. This one, the share price is a little more volatile. It does go up and down a lot more, which is why I haven't added to this one. I'm not selling it because the yield's still pretty good, but I'm not going to add to it. This I've added to. This I've added to. Got a big position in JEPI. So JEPI is actually a little more conservative because they buy millions of shares of the big cap U.S. stocks. So again, the $10 billion big names that we all know. And Home Depot, PepsiCo, Johnson & Johnson, Microsoft, and all them. And then they'll sell call options on that as well. So its yield is not as high, But again, you have the benefit of owning the big stocks and selling the call options. That's still a pretty good yield though. Again,
I bought some of those a while back after, I think it was one.
yeah, because that was a different handout, but yeah, but I've kind of expanded the list to include some of the new ones that I've had. And JEPQ, which is also run by the same company as JEPI, they invest in large cap tech growth stocks. So not the big traditional names that pay the dividends. A lot of the large cap tech also is found in here too. So you're still going to find Apple and Microsoft and Amazon in these, but you'll also find tech like Tesla and maybe Snapchat or a lot of the big social media stocks, Meta, Facebook. So these will generate dividend and options income. So large cap stocks that pay dividends and options, the yield is about 10%. So a little more conservative, a little more stable price. The catch is you're going to earn less of a yield, but that's totally okay with me because the price stability is good and you're still earning a double-digit yield. And then finally, I have shares of these, but I'm not adding to this one. This one also tracks the 100 biggest tech stocks, and then they generate more income, about an 8.5% yield. So good cash, but because it is in the tech and how they generate the options, their particular option strategy, there's a little more volatility there. So I'm not adding to those positions. So the four that I am adding to every month are these. So JEPI, JEPQ, SVOL, and XYLD. So I have a little mix of tech, a little mix of the big stocks, and all of them pay double-digit yields. So every single month I'm getting cash, which is nice versus a lot of stocks. Most stocks pay this quarterly, but these pay monthly. Every month I'm getting that income and I'm reinvesting all of that income into adding more shares. So the compounding is going to keep accelerating and snowballing. So that's the value there.
I didn't buy much of the JEPI, but every time I get the notification, I get excited about the dividend.
About the payment, yeah, every single month. I've actually figured out when they do it, like JEPI and JEPQ are usually in the first week of the month. And then XYLD, QYLD, SVOL, and NUSI, I think, pay at the end of the month. So.
Do you know if any of this are on the aristocrats, like the dividend aristocrats?
Well,
Because they probably haven't been around long enough.
no, and I don't think they'll ever be on the aristocrats because landing on the aristocrats list is tough because you actually have to raise it nonstop every year. And with these, because the call options are so volatile, the amount of dividend they pay every year can go up and down. So it's not going to raise all the time. And it's always dependent, their options income is always dependent on the market. So, but still very attractive yields and basically what I'm trying to do is build a foundation of passive income. So more and more as my shares grow, I can start generating passive income to start replacing my regular income. And that's the key. Yeah. The last thing I'm going to show before we head out is really just a chart. And this should be very encouraging because markets always grow in cycles, despite what people hear. Whenever you have a bull market, there's always going to be a bear market, no matter what. And if you're in a bear market right now, you should still and keep investing. And that's probably one of the most difficult things that people have doing is having a mindset of don't stop investing when markets are down. We've been in a bear market. For me, I've been in a bear market situation since December of 2021. So this has been a long bear market, longer than most people can recall, because the last one that lasted 2 years was 2008, 2009, and that's quite a while ago. But this is a real bear market. But if you have the courage to invest during times when all stocks are down, you'll be rewarded once the next bull market starts up. And they always go in cycles, no matter what. And people have been scared during all these different events. Black Monday, again, 1987, when the stock market got cut in half in a single day. Kuwait invasion, the first Gulf War. I mean, when people panic and sold basically all their shares, that's probably the best time to buy. People that bought shares during the summer of COVID and like airlines and restaurants and no one had an idea they were going to open, were greatly rewarded a year later. And when those stocks went back up, when businesses started opening up, Asian financial crisis. Let's go to look at something a little more recent. Russian invasion of Crimea in the mid 2010s. Hong Kong riots, the Brexit vote, small dip here. Russian invasion of Ukraine, big drop in the market here because we hadn't had a major scale war with a major power in decades, and that happened. So we're right here. Oh, COVID-19, again, huge drop. Every single asset dropped at least 50% in a matter of months. It was the fastest recession in history. But then, since then, if you just continue buying, say like every single month, like I did, all those stocks that you bought are probably higher. But then you were able to buy them a lot cheaper back then. You just had to be real patient. So yeah, we're right here. We're in a bear market, but over time, if inflation finally gets down to 2%, if say the next year, 24 or even 25, when the Fed decides, okay, we've been in a recession long enough, let's start lowering interest rates, it's going to reverse. Or what if again, and may not be likely, but it could be possible. What if the Russians give up because they're getting beat on the battlefield for so long, and the country goes weary of war, and they decide to call a truce? Well, that's going to cause the market to shoot up. Sure, I'm not betting on that anytime soon, though, because the Russians are very stubborn. It seems like, and they're too prideful to say that they've lost. So, but nevertheless, something will be a catalyst of this going up and starting a new bull market. I think it primarily it's just going to be economics. So one catalyst could be in 2024, presidential elections. Presidential elections are always catalysts for a market. When there's uncertainty of who's going to win, and then the certainty of someone actually getting elected happens, markets usually rejoice, saying, okay, now we don't have to worry about presidential election. Let's go ahead and bid stock prices up. So there's always cycles. And it's just being aware of those cycles and being confident that history always repeats itself. So whenever there's a bull, there will always be a bear, and vice versa. You just have to wait for the next one to happen. I'm patiently waiting for the next bull to happen. Yeah. So I think it's going to be traditional. An average bull market or bear market lasts for about 14 months. So we're around that time. Again, about a year and a half in. So sometime within, maybe not the next quarter or the next, but it could be maybe the last quarter of the year. Could be the bottom of the recession and bear market, and there will be a turnaround. It's not a matter of if, it's just a matter of when, and that's when you have to be patient in investing, stick to the plan, and buy stocks that you have no fundamental change in why you bought them in the first place. Like I still have total confidence that I'm not selling my Microsoft stock, I'm not selling my Apple stock, and I'm buying more Alphabet and Amazon. I was buying Netflix, but then Netflix has all the subscriber issues, losing subscribers, so I stopped buying Netflix. So, and I sold some, but although Netflix is coming back now that they're cracking down on password sharing,
Yeah.
which is pretty big to try to preserve their profits, and the stock has actually made quite a run up the last few months. So, but that is it for today. Any questions before we head out? All right. Thanks for coming. And again, if you have any suggestions on topics for next month, let me know, and I'll add it to the agenda for May. And hopefully we'll have our nighttime meeting back again over at South. And then I have to make a decision on summer meetings because I'm planning to go to Europe this summer, so I won't be here.
Doing more,
Portugal, yeah,
yeah.
gonna hit that. Well, let me stop the WebEx from recording. Oh, sign in the WebEx. I was recording.
something.
Oh, yeah. Okay, good. All right. I had a different, let's see, it's the different window at this workstation and a different window that is up here. So that's what I'm still confused about, which is really. All right. Yeah. All right. So I can start recording. Oh, wait.
You said you've been to Rome before? I know you said.
Yes, yes, I have.